One of the most overlooked aspects of raising capital is the corporate structure of the business. Founders tend to think of structure as paperwork, something you set up once, file away, and forget. But in capital markets, structure determines everything. What types of investors you can attract, how fast can you raise, what exemptions you can use, how your securities are classified, how your board operates, how governance is enforced, and ultimately, how your company is valued. Today, we're covering the full framework: LLC, C Corp, S Corps. Why almost all investable companies become C Corps: parent companies, subsidiaries, and holding structures, voting versus non-voting shares, preferred versus common stock, how governance affects valuation, why investors care so deeply about structure, and how poor structuring kills deals. Let's start with the basics. LLC versus corporation. Most small businesses begin as LLCs. LLCs are simple, flexible, and tax efficient for small ownership groups. But when it comes to raising capital, LLCs have major limitations. Pass-through taxation creates complexity for investors. Units instead of shares complicate securities classification. Operating agreements vary widely, no standardization. Difficult to create preferred classes with sophisticated rights. Harder to administer cap tables as the investor count grows. Many crowdfunding and Reg A platforms will not accept LLC issuers unless structured specifically. As investor counts grow into dozens, hundreds, or thousands, LLCs become impractical. This is why most companies raising meaningful capital convert into C corporations. Why C corporations are the standard for capital raises. C corps offer predictable structures investors understand, including share classes, voting rights, preferred stock, convertible notes, warrants, drag-along and tag-along rights, board governance, security compliance frameworks. Institutional investors, venture capitalists, private equity funds, and public markets all expect a C Corp. They know how shares behave. They know how governance works. They know how to value the structure. C Corp taxation is often misunderstood. Yes, C Corps face double taxation. But when you're raising capital, structural clarity outweighs tax optimization. S corporations. Why are they poorly suited for raises? S corps cannot have more than 100 shareholders, have non-U.S. owners, issue preferred shares, create layered capital structures, or raise from institutional investors. This makes S corps incompatible with serious capital raises. Most S corps that raise capital eventually convert to C corps. When companies move towards capital raising, they often adopt multi-entity structures. A common model is holding company, operating subsidiaries. The parent owns 100% of the subsidiaries. Investors purchase shares in the parent, which consolidates financials from all subsidiaries. Benefits include cleaner investor structure, ability to acquire additional companies under the same umbrella, separation of liability, ability to sell subsidiaries independently, ability to perform roll-ups, stronger governance and reporting. This structure is common among private equity groups, franchisors, multi-location operators, and companies preparing for public markets. Think Berkshire Hathaway. Companies often issue multiple share classes: voting shares, non-voting shares. These determine economic rights and decision-making power. This protects the company from being overtaken by shareholder votes while still offering investors participation in the upside. Preferred stock versus common stock. Most capital raises involve preferred stock, which may include liquidation preferences, anti-dilution mechanisms, redemption rights, dividends, conversion rights, priority, and payouts. And let's move to governance, the silent force behind every capital raise. Governance is the system of rules and practices that direct a company. Investors care about governance because poor governance leads to fraud, misallocation of funds, weak internal controls, leadership disputes, lawsuits, loss of shareholder value. Strong governance includes independent board members, audit committees, financial controls, documented decision making, clear bylaws, separation between ownership and management. When companies have strong governance, investors feel protected. Weak governance kills deals instantly. Why structure affects valuation? Investors price risk. The more structured and standardized your governance framework is, the lower the perceived risk. Better structure equals higher valuation. Investors pay premiums for companies with clean cap tables, standard share classes, clear governance, good bylaws, subsidiary structures, and strong board oversight. This is why private equity firms spend significant time restructuring companies before buying them. Clean structure creates value. Why poor structure kills deals? Examples of structural issues that scare investors can include commingled finances, unclear ownership, verbal agreements, no shareholder agreements, no vesting schedules, unassigned IP, toxic cap tables, unusual share classes, founder disputes. Investors walk away from structurally risky companies regardless of how profitable they are. Structure is the foundation of investability. The key takeaway: your corporate structure is not an operational detail. It is capital strategy. Every decision, entity type, share classes, governance, subsidiaries affects your ability to raise funds, your valuation, and your path to exit. Companies that structure themselves intelligently attract institutional capital. Companies that ignore structure limit their future before they even begin.